Thanks very much. I should say at the beginning of the discussion, as a former preparer, former bank preparer, CFO of a company, I can't quite remember ever having to face so many regulators in one go. It's slightly intimidating. You'll be glad to know that what we've done over the last 2 days is the easy part of IFRS. What we'll get into the next 2.5 days, financial instruments, is the more challenging part of IFRS. So hopefully there are a few things in here that we can tell you that we can surprise you with and perhaps raise some interesting questions as we go through. What I've done with the presentation that you're going to see is the same presentation that's in the books that you've got in front of you. I have hidden some of the slides because I think there's additional information that you can get from the books that you don't necessarily need in a presentation. And I've also done something for my own to make it easier as I work through the slides, which is I've highlighted some of the words as I go through. That's just helped me remind me which slide I'm looking at. It doesn't actually make the slides any different from what you see. But for those of you who want to cheat as we go, feel free to highlight the same words I've highlighted, because hopefully those are the important words on the slide. All right, just at the outset, IAS 39 is our primary financial instruments guidance. It is the main slide. It's the main standard that we use when we're dealing with the measurement and classification of financial instruments. We are in the process right now of moving from IAS 39 to IFRS 9. IFRS 9 will be our replacement standard. It takes over from IAS 39, and it will change a few things as we go forward. Today, Philippe and I are going to be talking about IAS 39 and IAS 32. So we're talking about the accounting standards as they exist right now, the way they're applied right at the moment. The process of moving from 39 to IFRS 9 is a process in phases. So we have 3 phases that we'll be busy going through: the classification and measurement phase, the general hedging phase, and finally impairment. All 3 of those, as I say, we'll discuss tomorrow, so I'm not going to touch on any of the process today. What is important, though, just to note for the purposes of the environment you operate in, is it is possible that some banks may choose, or some insurance companies or some other companies may choose to early implement portions of IFRS 9. We've allowed, in this progress of moving from the old standard to the new standard, we've allowed certain pieces of it to be adopted early, and that means that you might start seeing IFRS 9 coming through. As I say, the focus of today is going to be on IAS 39. It's going to be on the old standard. The new standard is only likely to come in 2016 or thereabouts, so for the most part you're not going to see the new standard at all for quite a while. So what is 39? It is, as I mentioned, recognition and measurement of financial statements, of financial instruments. It was first effective in 2001. It was revised in 2003, 2004. In my introduction, Pascal mentioned that I'm from South Africa. South Africa was the first country to adopt IAS 39. Up until we adopted IAS 39, most of us in banking had absolutely no interest in the financial standards. We just knew the financial standards came to us from London. We weren't worried about how they happened to us. We just applied them when they happened. We first had to adopt IAS 39 in 2001. It was an incredible shock to our system. It was an absolute horror show to try and get this done. We spent a number of years trying to get the work behind the scenes up and running, and no sooner did we adopt it, and we adopted it in 2002, no sooner did we adopt it than the IASB changed it in 2003. So out of that whole process came the fact that South Africans are now very interested in what the IASB does. We get very involved in what the IASB does because we don't want to get caught short again. And part of the reason why we do these presentations, why we get out and talk to people, is to help you understand what the IASB is doing, so you have the opportunity to stop us if it looks like we're going to do something silly. It's why I became involved in things like the advisory committees and the IFRIC, and why I'm now involved in the IASB. And it's why we look to people to comment and to tell us and to comment on what we're actually doing to try and help us prevent doing those sorts of things in the future. So what is the scope of IAS 39? IAS 39 applies to all financial instruments, anything that would be called a financial instrument except for, and there's a fairly long list of except fors here. Subsidiaries, associates, joint ventures, you heard about those yesterday, you heard about how they actually dealt with the consolidation process. Leases, we have a separate standard on leases that actually tells you how to deal with leases. Pension obligations and assets are quite an important sub-criteria of accounting, and we deal with them very differently because they can be such big numbers on the financial statements of companies who otherwise don't have anything to do with financial instruments. So they dealt with separately. Insurance contracts, which we'll deal with a little bit on Friday, that's again a whole subtopic on its own, and I think for the insurance regulators here, there's quite a lot of interesting things happening in IFRS for those, but those are completely out of financial instruments. Provisions, so liabilities that come up as a result of expected future events are dealt with under IAS 37. Business combinations, as I mentioned, share-based payments, so share options and the like, are all outside of this. And issuer accounting for equity instruments. When I issue my own equity instruments, I don't deal with it under 39. So what I've given you is a long list of things that are not in 39. But obviously, if you think about it, these are very unusual, very specific types of instruments. And many, many financial instruments qualify for 39. Many, many financial instruments don't fall under these categories. We've also got a few oddities in the way we identify the scope. The first is financial guarantee contracts. And financial guarantee contracts are something that you see both in insurance and in banking type of organizations. A financial guarantee contract is simply a contract that compensates somebody, the holder, for a loss it incurs because a specific debtor has failed to make a payment. Now that can be considered a financial instrument. It's a normal banking instrument that occurs very often. Things like letters of credit and the like fall into this sort of space. But equally, it fulfills, or it's part of the definition of what we call insurance. And so in order not to force banks to do insurance accounting or force insurers to do bank accounting, what we said here is financial guarantee contracts can either be in the scope of the financial instrument standard, or they can be in the scope of the insurance standard. And it simply depends on what your business is, what you've previously done with those instruments. If previously you treated them as insurance, you continue to treat them as insurance. If not, they're financial instruments. Likewise, another odd one from a scope perspective is loan commitments. Now, anybody who's dealt with banks, who's been dealing with banks over a period of time, will know that loan commitments are a very fundamental part of a bank's business. But generally speaking, from an accounting perspective, we see loan commitments as an off-balance sheet thing. It's not on balance sheet yet because I haven't actually paid out any cash. There's not yet been a transaction. So the only time that I would regard a loan commitment as being a financial instrument is if there's something odd about it. I can settle it net in cash. In other words, I can get out of that loan commitment for a fee. I sometimes sell my loan commitments onto somebody, or straight after I've made the loan, I sell it onto somebody. So the loan commitment has a value to me, because it's a tradable instrument. If I have designated the loan commitment at fair value, just stop there for a moment and think. If I advance a loan commitment to somebody, if I say to a client that on demand they can borrow money from me, so I will lend them money whenever they want it on demand. As long as that is at normal interest rates, it is at it's in the normal course of business, there's no funnies about the transaction, then actually when I lend it, I have a normal transaction. When I lend it, I have something that's happening at fair value. If I've designated it fair value through profit and loss, it tells me something else is happening there, because there's now a value to the loan commitment in and of itself. So I would recognize it on my balance sheet because there is that inherent value in it. From an amortized cost perspective, there's no value to loan commitment. I haven't given any money. I haven't actually done anything. So there's no value until such time that I'm forced to give money. And hence we would scope it out of there. But if I have promised a loan commitment at a lower than interest rate, so market interest rates right now are 10%, and I've promised you that I will lend you money not at 10% but at 5%. Well, actually there is an inherent value in that loan commitment. It's a negative value because I promised you that I will lend you money at less than the market rate of interest. So that negative value needs to be reflected on my balance sheet. It's a financial instrument in and of itself, a loan commitment. So all of these things would be into IAS 39. Any normal loan commitments made in the ordinary course of business in terms of which I will lend you money at a future date at a market-related interest rate are simply a contingent asset. It's a contingent thing that I'm going to do in the future, and I wouldn't record it under financial instrument standard. Another scope exemption is for own use. Now, very often derivative instruments are used, and we're very familiar in the banking sector with the way derivative instruments are used. They're used to expose me to a certain risk or to protect me from a certain risk. They're financial instruments with a financial purpose. Likewise, in the insurance industry, you'll very often use financial instruments for a very specific purpose. The purpose in that circumstance is to do things like extend the duration of my portfolio or change the duration of my portfolio. All of those things are very specific financial reasons for entering into a derivative type instrument. But once you go outside of the financial industry and you get to people like airlines and to people like copper dealers and stuff like that, derivative instruments tend to be used for a different thing. So if I'm an airline and I know that I'm exposed to the dollar risk, and we'll do that a little bit later in the case study we have this afternoon, I know that I'm exposed to the dollar price risk of the jet fuel that I buy in. Okay. I have a risk that I want to somehow deal with. If I deal with that risk by forward purchasing the fuel I'm going to require, what that means is I'm actually going to receive at a future date the fuel, and in return for that fuel, I'm going to give up money, a predetermined known amount of money. That's an own use derivative. I'm simply using it to facilitate the delivery of the underlying commodity that I use in my business. In that circumstance, I can be exempt from IAS 39. I can be outside of IAS 39, and I can treat it under the normal standards that an airline would do. How do we decide if it's own use? Well, the first thing, the major test, is that it cannot be own use if it's net cash settled. It cannot be own use if actually I'm not going to receive the fuel, I'm just going to receive money. So we've got a bunch of tests that we look at here to determine whether something is net cash settled or whether something's actually going to result in physical delivery. Physical delivery can be scoped out of 39. Anything that is net cash settled is automatically in 39. Philippe will talk this afternoon about IAS 32. IAS 32 is our classification and measurement, is our classification presentation standard. What we're dealing here with is classification and measurement. The two standards operate together. They've got a lot of similarities, and I'll talk about some of the similarities as we go through the rest of the presentation. But importantly, there are also some differences. And the most important differences is that 32 deals with more things than 39 does. So 32 deals with equity instruments and how the issuer accounts for their own equity instruments. 32 deals with some leases, forward contracts, and a few other things are included under 32. So if you like, 39 takes a subset of what is in 32 and explains how you measure that subset. As I say, when Philippe talks this afternoon, he will talk about that bigger subset. And then some things get routed from there into our leases standard or our business combination standard, and some things come directly to 39 for measurement. One of the things that 32 does is measurement, is definitions. Now when it's doing definitions, what it's doing with definitions is defining a bunch of things that would fit under this ambit of 32. Those definitions get carried over into 39. So 32 defines a financial asset, and it defines the list of things that you can see here: cash, equity in another entity, the right to receive cash or financial asset, and the right to exchange instruments. Again, I'm not going to go into too much detail because there's some complications in the definitions, but Philippe will cover the definitions later when he speaks about 32. The important thing is financial assets are quite a big category, and they include things that are complicated, derivative assets and those sorts of things, and they include things that are very, very simple. Cash. Cash is one of the simplest things you can think about, but it is a financial asset. Likewise, financial liabilities, the definition comes from 32. Philippe will talk about the definition a little bit later. But a financial liability is simply the reverse of the asset. An asset is the right to receive something, okay, to receive cash, to receive another financial instrument. A financial liability is the obligation to deliver that cash, to deliver another financial instrument. So it's simply the inverse of the asset definition. Equity is a trickier one, and this was covered a little bit. It would have been covered a little bit in the first day when you did things like conceptual framework. But really, what equity is, from an accounting perspective, is it is the residual. It's the leftover amount. So I have my assets, and I know what my assets are. I have my liabilities, and I know what my liabilities are. The difference between my assets and my liabilities, by definition, is my equity. So in accounting, from an IFRS perspective, we take the assumption of a balancing balance sheet and make that into part of our definitions. When I talk a little bit tomorrow about the difference between the regulatory view or the accounting view as seen from a preparer perspective versus the accounting view as seen from a regulatory perspective, this is maybe one of the biggest differences that come out. From your perspective as regulators, one of the most important numbers you look at is the equity, the capital of an entity. And a lot of the regulatory frameworks define exactly what you mean by capital, what the different levels of capital are, how different tiers work, what the relationship is between capital and the assets that you're allowed to hold. From our perspective, from an accounting perspective, it's simply the amount that's left over. It's the amount that remains afterwards. We do have a couple of requirements. So, for example, if I, under any circumstances whatsoever, am obliged to repay some of that capital, or I am obliged to pay interest or dividends on that capital. Note the word obliged, so not an option. Then we would say from an accounting perspective, it can't be capital. There's an obligation. And the moment there's an obligation, that's a liability. So we would hook anything out that's got any kind of obligation attached to it. But importantly, with that subtext understood, we would still argue that it is the residual category, it's the leftover bit at the end. The one definition that is unique to IAS 39, a definition that doesn't actually come up in IAS 32, so it's defined specifically from an IAS 39 perspective, is derivative financial instruments. And derivative instruments are instruments that have to meet a few criteria. The first criteria is they need to have value changes that are linked to some underlying factor, to some underlying item. Okay, so there needs to be a change in interest rates, or a change in equity prices, or a change in foreign currency as the starting point to say that you have a derivative. The derivative is something that's value changes over time depending on what's happening with the underlying. A derivative is also marked by the fact that there's little or no initial investment. I could say that I lend money as a loan. I make a loan to somebody. That loan is subject to movements in interest rates, for example. Its value changes as interest rates change. However, the big point about a loan is there's a very big upfront investment. I'm putting a lot of money down on the first day. And the vast majority of my movement is only, or the movement is just a little bit on top of the actual investment I've made. A derivative brings in the concept of leverage. There's leverage in a derivative because I put down a very small amount of money, but I see very big movements over time. And of course, for a derivative to be a derivative, it needs to be settled at a future date. If it was settled in the past, it's of no relevance to me because it doesn't matter, it's not on my balance sheet anymore. If it's going to be settled at a future date, it is a derivative instrument because I've entered into a contract where some kind of deliverable, some kind of cash flow will happen at a future date, and all these other things are then met. Importantly, for a derivative to be considered a derivative, it doesn't have to be settled net. You can have gross settled derivatives. And again, in many of the financial markets that we operate in, you will see that. You will see swap instruments, for example, where you have gross settlement on both legs of the swap. On some foreign exchange instruments, you have gross settlement of the full amount of the dollars in return for the full amount of the euros. Inversely, you can also have net settlement. You can choose just to settle the net amount, the difference between the two swap legs, or the difference between the two foreign currency legs. So you've got both kinds, and both kinds fully qualified derivatives. When I talk a little bit later, you'll see why it's so important for us to get the definition of derivatives right. Because our accounting for derivatives is very different to our accounting for normal instruments or for more traditional instruments. Right, accounting deals with classification, and as I mentioned when I started, the IAS 39 deals with classification and measurement. It's maybe worth just taking a moment out to define a couple of terms from an accounting perspective. When we talk about accounting, we have sort of 5 primary terms we use. Classification, whereabouts on the balance sheet does it go? How do you actually decide what type of asset and what type of liability it is? Measurement, how do I measure the amount of that asset or liability? Recognition, when does it come onto my balance sheet? When do I decide that I bring it onto my balance sheet? Presentation, where do I show it when I'm actually presenting my balance sheet and income statement? How much do I show it as a separate line item? What kind of line item is it? And then disclosure, what additional enhancing information do I give in my financial statements? Liquidity profiles and things like that are all about disclosure. So when we talk here, we talk a little bit about dividing it up into different sections. As I mentioned earlier, IAS 39 deals with classification and measurement, and IAS 39 also deals with recognition and derecognition. IAS 32, which Philippe will be talking about later, talks about presentation. How do I decide what type of instrument it is, asset, liability, equity, and where do I put it? And IFRS 7, which Philippe will also cover later, deals with disclosure. What is the enhancing information that I'm going to give? So when I'm looking at classification, the first item of classification that's important is unit of account. Okay, now I have a contract. Legally, I have a single contract. The starting point from an IASB perspective is each contract that I have is a unit of account. I start by looking at the individual contracts, and in normal circumstances, what I'm going to do is I'm simply going to flow that contract through and account for it as a single contract in my financial statements. But IAS 39 also introduces the fact that from time to time, I'm going to have hybrid contracts. A hybrid contract is a contract that's got more than one thing happening in it. And under certain circumstances, and we'll talk about it a little bit later, if I have a hybrid contract like that, IAS 39 requires me to take a pair of scissors and cut that contract into two pieces. The one piece is the host contract, the core contract, the main contract that I've dealt with, and the second part is an embedded derivative. Something in that contract that makes the contract not a normal contract. We call that, by the way, bifurcation. That act of cutting the thing into two pieces is bifurcation. Actually, out of interest, there are a bunch of words that the IASB has not quite invented. I think bifurcation existed before the IASB came along, but has certainly raised to new prominence. So bifurcation is probably not an English word you would use anywhere other than talking about IFRS. And most spell checks reject bifurcation. They don't actually know how to deal with the word. So it becomes one of those ones that you have to deal with fairly carefully. All right, so I said bifurcation counts when you're dealing with a hybrid contract. And the hybrid contract has got those two components, embedded derivative and a non-derivative host contract. The embedded derivative will be separated only if, so I will only cut that contract into two pieces, if they are not closely related. What closely related means is that they are so linked into each other that I can't actually do that cut. I can't actually cut through the two contracts and cut it into two pieces because each one changes the other one. They interact with each other. Also, the derivative part, the embedded derivative, must in itself meet the definition of the derivative. So it needs to be, for lack of a better term, a viable instrument. It needs to be an instrument that I can actually go out and sell to somebody because it's a real instrument that has real cash flows to deal with. And importantly, the last point, the hybrid instrument contract is not fair value through profit and loss. The logic behind that last point is that the problem with an embedded derivative is it can't be measured in a normal way. It needs to be measured at fair value. Because what's happening with that embedded derivative is it's so complicated, its underlying activities are so complicated, that amortized cost doesn't tell you anything about it. And that's in fact the same principle for any derivative. Any derivative instrument that you have has got all these complexities in it, that it's impossible to take a derivative instrument and say, I paid €1 for that instrument. Therefore, in perpetuity, €1 is a useful bit of information to know about. Generally speaking, with a derivative, the day afterwards, the euro has become irrelevant, and what is relevant is what's the fair value. Likewise with an embedded derivative. The day after you've purchased that instrument, the day after you've acquired that instrument, the day after you've issued that instrument, the value at which you issued the embedded derivative is irrelevant to understand what's happening in the financial statements. So we say that you need to fair value the derivative instrument. However, taking that last line into account, if you are already fair valuing the whole instrument, then there's no reason to do the cut thing. Because you already got the fair value, so you don't need to worry about the So you will only separate a embedded derivative if the host instrument is not being carried at fair value. It's being carried at amortized cost or something similar. So when do I bifurcate? The timing of the bifurcation assessment happens when the party when I first become party to the contract. So at the point in time that I am now involved in the contract, at the point that I recognize the contract, I have to do the bifurcation at that point. I can't then reassess. I can't change my mind. Unless what's happened over a period of time is that I have substantially modified the contract. So I've gone out and I've changed the terms of the contract, I've changed the wording of the contract, or I've reclassified an instrument that was previously at fair value out of fair value. So when I originally did this, I said I don't have to bifurcate because the instrument is at fair value. Later on, for some reason, I moved that instrument out of fair value. At that point, I'd be required to bifurcate or to reconsider the decision. But generally, you make the decision once at the beginning of the contract, and you stick with that decision through the whole life of the contract. You don't look at it again. How do you do the bifurcation? You need to go through a few steps. The first one is if you have an equity type derivative, a derivative that's linked to equity instruments, then that's the first part that you must split out. Likewise, if you have different derivatives that are doing different things. So I have an instrument that says that I will repay a loan. Okay. I don't have to repay the loan though if my share price drops below a certain level. So now what I've done is I've linked that to a share price. Okay. And I have an interest rate cap. So interest is variable, but it won't go above a certain level. What I'm looking at is I've got three instruments there. I've got a loan. I've borrowed money from somebody. The instrument has an interest cap in it. So although it's a variable rate instrument, it gets capped at a certain level, so it could stop moving at a certain level. And I've got an equity link in the contract. The contract is linked back to equity. What I need to do is I need to first strip out the equity component and account for that separately. Then I need to strip out the interest derivative component and account for that separately. And then I'm left with the loan, which is my host contract. Looking at the terms of the embedded derivative can be quite difficult because remember, the embedded derivative didn't exist as part of the original contract. I've identified it in the contract. So I need to look into the contract and identify either the stated terms. So it's very easy. If I'm talking about the interest rate cap, it's very easy. I know exactly what the stated terms are. The stated terms say I have an interest rate option effectively to stop paying interest above a certain level. And it's clear from the underlying contract what those terms are, so I can use those terms. The terms might also be implied. So they might not actually be explicit, but there might be a way of determining from the contract what the implied terms are. And I can take those implied terms in such a way to calibrate the fair value to zero on the initial recognition. So what I'm going to do is I'm going to take those terms and say, because I didn't pay extra for the derivative, because I didn't pay an extra amount in order to get that derivative, the fair value of the derivative on day one must be zero. It's not yet in the money or out the money. It will go in or out the money over a period of time. Yes?
This lecture on IFRS 13 and fair value. So there was a case when we can get this fair value at initial recognition different and not equal to zero if we have access to different markets.
So
how is that?
We'll talk about that a little bit later in terms of the way fair value would work when you don't have an arm's length transaction or you have principal or advantageous markets. But the important thing for what we're doing here, remember, is that we're taking a single instrument and we're cutting it up into multiple parts. So the assumption here is one of those multiple parts, the derivative instrument, has a value of zero on day one. That means if I need to adjust their value, I would adjust something else. I'll adjust the host contract or one of the other parts because it's got three different contracts. Better derivative is always zero, so whatever the residual is, whatever's left over as the value, must be the host contract. And I can then ask myself, is the host contract contracted at fair value, at market? Did you also have a question? Okay, next slide. All right, in anticipation. I'm now scared to press the button. And the next one is, let's see. Okay, there we go. All right, so classification when we get, well, all right, the next one I think was the examples of...
Yes,
I have... Perhaps ask me.
Thank you. Yeah, I'm sorry you skipped that one. It's very interesting for our economists. So I work with the central bank from Croatia. In our economists here present, the regulators are presenting, we have a very substantial part of the financial assets are housing loans, in which the payments are indexed to foreign currency. Usually they are not classified as financial assets with embedded derivatives, but just normal loans and receivables.
Yep.
Lately, we have strong pressure from the audit firms, all of the big four are present here for the last 15 years. Suddenly it came up to the idea that those loans might be some of the financial instruments that should be carried at fair value at least, or that this host contract should be divided from the embedded derivatives. So, of course, the outcome for the P&L is completely different. So, I'm just asking a straight question. It's like Hungarian housing loans in Swiss francs and euro. Are those the ones that could qualify as a financial assets with embedded derivatives?
And certainly on the face of it, and it's always important when you answer a question right at the beginning, you might have seen that little comment. The comments expressed by the board member are my comments and my views only. In my view, certainly I would see those as derivative instruments, because what the company is doing, what the bank is doing when they lend money to somebody in a foreign currency. Well, let's specify. There's two different ways. I can lend money to somebody in a foreign currency. So I lend you US dollars. Okay. When I've lent you US dollars, it's very easy. I've got a US dollar loan, and I need to mark that US dollar loan to whatever my presentation currency is. And I see a profit and loss as a consequence of that marking. When I lend you money in euros, but put a derivative next to that instrument that says that I can actually convert those euros to dollars, or you convert, I'm actually giving you a very specific right, a very specific ability to do something against me. Okay, you will exercise either the option or the swap, and as a consequence of exercising that option or swap, I will make a loss potentially. Okay. To my mind, that is something that should be shown at fair value. So I think that is the correct, I would argue that it is the correct treatment to carve out the embedded derivative. What is important here is the difference between those two examples I've just given you. Did I lend the money in dollars, or did I lend the money in euros with a derivative that allows you to swap them into dollars? So what becomes important, again, is to see the terminology, to understand the actual terminology of the contract. Importantly, this is one of the issues that we're dealing with right now under IFRS 9, where people have raised the same comment, that some instruments that in many jurisdictions are seen as vanilla type, normal type instruments, suddenly appear to have this additional factor in them. The treatment under IAS 39 is actually pretty easy treatment, because what 39 is saying is just cut out that piece of the derivative, tell us what that fair value is on that, and if you hedge the risk, and hopefully what the banks are doing in this circumstances, they're hedging, they're protecting themselves against the exposure they have to currencies. If they hedge that risk, then the hedge will also be at fair value, and so the two set each other off. If they're not hedging the risk, so if the bank is saying that I'm exposing myself to a US dollar or to a euro or to something else, but all my other assets are in Swiss franc or in some different, then there is a real risk the bank is running, and that real risk is reflected in the numbers that it's presenting.
Our problem are not the banks, because they are smart enough to hedge themselves. The problems are the clients who are not hedged and are exposed to foreign currency volatility. So that's our problem. And increasing the credit risk and blah blah and so on.
So if I were to think about it in those circumstances, I'm guessing that the clients, and again without specifically seeing the contract, I'm guessing the clients do have real foreign currency risk. They have taken a real risk. Now
when the Swiss francs went to heaven, yeah.
Yes. And so then it's difficult to argue that that is not relevant accounting. Because by showing that risk in your income statement, you're telling people that you took the risk. Again, if I were a company whose all its business was done in Swiss franc, and I borrowed my money in Swiss franc, well then I don't have risk. And that would be reflected in the accounts. But if I'm a company who all my business is done in euros, but I'm borrowing in Swiss franc, I have a real risk and I need to show that. So I think the accounting is correct here. All right, so moving on then to classification of financial assets. How do we split the financial assets up between the different categories? So we have 4 categories of financial assets. On the one side, we have fair value categories, which are the fair value through profit and loss and the available for sale categories. That's on the left-hand side of the screen as you're looking at it. On the right-hand side, we have the amortized cost assets, or amortized cost treatment, which is the loans and receivables and the held to maturity. The left-hand side, the fair value, is split into 2 further categories. So fair value through profit and loss and available for sale. Fair value through profit and loss, as the name says, goes through profit and loss. Available for sale, the change in the fair value of the instrument doesn't go through profit and loss, it goes through OCI. Whole treatment of OCI is relevant from a regulatory perspective because what happens is OCI is a volatility absorber. It helps remove some of the volatility from fair value, from the profit and loss. So if I have instruments in that bottom category and available for sale category, even if the instruments are changing in fair value regularly, and remember I'm reporting those instruments at fair value, the change in fair value doesn't go through profit and loss, it goes through OCI. Banks, insurance companies are very, very dependent on market perceptions of their stability. So market perceptions of stability are affected by how much profit and loss goes up and down. So a more stable profit and loss is generally can lead anyway to a more stable banking environment or insurance environment because you're not seeing the moves. At the same time, because it's going into OCI, it's having a direct effect on capital. And because capital is residual for us, we find it just goes into capital. From your perspective, you need to understand what's entering this capital number, what that OCI number actually means when it gets in there. So, fair value through profit and loss. What are those instruments? The first one is obvious. It's the trading instruments, where the purpose of getting an instrument, a financial instrument on my balance sheet is because I'm getting it on because I intend getting it off again. I'm buying it in order to sell. Or it is an instrument that is part of a portfolio where I regularly buy and sell instruments. Or, and here's where I said derivatives is so important, if it is a derivative, it is always fair value through profit and loss. So derivative always goes at fair value through profit and loss. Okay, and we'll get onto hedging a little bit later unless it's hedging. You can also choose to designate something fair value. So over and above the stuff that you're required to have at fair value, you can also choose fair value as an option. You can choose it in one of 3 circumstances. If it eliminates an accounting mismatch, so the circumstance there might be that I have a liability at fair value, I want to carry my asset at fair value too, that's how I eliminate an accounting mismatch. Or I manage the asset on a fair value basis, so the normal way I look at that asset is fair value. Or bifurcation I talked about, cutting it up, it's very complicated, so we allow you, if you were otherwise forced to bifurcate, we say instead you can cut this instrument into 2 and instead of cutting it into 2, you can fair value the instrument. It's a choice that you can make. Loans and receivables are accounted for at amortized cost on that table that we spoke about. For something to be a loan and receivable, it must be a non-derivative. There must be fixed and determinable future payments. It mustn't be quoted in an active market. And it mustn't be an instrument that in turn has a share in an underlying pool of instruments that are not themselves loans and receivables. From an entity perspective, I need to have, so those are all the asset characteristics. From an entity perspective, I also need to say I don't intend to sell it, and it's not designated as fair value or AFS at initial recognition. A held to maturity instrument is an instrument that I've bought. Now, it might be a quoted instrument or it might be bought as part of a transaction. It is also a non-derivative instrument, fixed determinable payments, and a fixed maturity. So I need to know when the instrument is going to mature. So here's an instrument that I've bought in. I want to measure it at amortized cost. So I need to satisfy these requirements. Also, from an entity perspective, I need to be able to show that I have an intention and an ability to hold that instrument to maturity. So I've got quite a few tests to make sure that I am actually going to hold this to maturity. Some types of sales are permitted. So I'm not going to say that because it's held to maturity, I have to hold it to maturity no matter what happens. If there are, for example, credit events or tax or regulatory changes that force me to sell, then I am allowed to sell the instrument under accounting. But if I sell it for any other reason, if I sell that instrument for, so I bought the instrument in, I hold it for a year or two, I bought it held to maturity, and then I sell it, and it's not for credit, and it's not for tax, and it's not for regulatory reasons. In that circumstances, what I do is I taint my portfolio. If I taint the portfolio, I'm not allowed to call that portfolio or any other portfolio held to maturity. Tainting means I've actually broken the rules, and I'm now being punished for breaking the rules. And I have to take it out of held to maturity and put it into one of the fair value categories. Question at the back.
What is the threshold here? What is material? If the entity has a maturity portfolio and it's not part of this portfolio, what is this threshold? How
The only materiality that we apply is the conventional materiality. Any other sales is enough to trigger it. So any sale, other than the ones we allow you to do, are sufficient to taint it. Remember what you said is up front you've made a clear expression that you do not intend to sell. And now you've changed that, and that's the concern with this one. Okay, available for sale instruments. So now we've gone through the fair value, which is fair value through profit and loss. We've gone through loans and receivables, amortized cost. We've gone to held maturity, instruments I've bought that are amortized cost. The final category is available for sale. Here it must just be a non-derivative financial instrument, so any other assets will actually count. It is a residual category, so if I've gone through all three blocks and said no, no, no to all three blocks, then it ends up in this block. It's also one that you can choose, so you can choose to designate something available for sale. And one of the reasons why people will choose this is because they believe fair value is important reflection of their accounts, but they don't believe that the movements in fair value are an important indication of their performance. So it's that distinction between the two that comes in there. Yes?
Can the change in fair value of available for sale instrument bring the result negative number in capital?
It can absolutely. So if the value of an available for sale instrument falls,
I mean, maybe it is not a good example, but the change in during the revaluation of PPE, we cannot have a number lower than the. In this case, we can have a number lower than the.
so let me answer that two ways. The asset itself can never be lower than nil, because it obviously then something else has happened, and that would appear to indicate that you're dealing with a derivative instrument. But if the asset value falls, if I buy an asset for 100 and the value tomorrow is 90, okay, from a fair value perspective, I need to consider one of two things that's happened. Either from a fair value perspective, I say it's a short-term fall in fair value, and I take that 10 to OCI, and then from OCI it becomes a negative number in my capital. So I have a capital of whatever minus the 10, the negative OCI number to get me. Or I can say that it's a prolonged deterioration in value, in which case it's an impairment, and then the impairment goes through my profit and loss. So I take that 10 through profit and loss, and that would also have the effect of reducing my capital. But certainly if the question is, can I have negative OCI? Can I have OCI in debit? Yes, I can. And one of the things from a regulatory perspective from the olden days when I was here, when I was in banking, there was two ways of treating it. If I had positive OCI, it did not form part of my capital, because from a regulatory perspective, it was seen as a temporary change. But if I had negative OCI, it was seen as an impairment against my capital. And I actually reduced my capital for that. I haircut my capital for that. All right, financial liabilities, likewise, can be split into a couple of different categories. I've spoken about financial guarantee contracts and loan commitments and the way those are treated. On the other side, I have simply fair value through profit and loss or amortized cost. So on liabilities, I actually have just the two categories, fair value and amortized cost. Liabilities held at fair value through profit and loss, again, liabilities that I hold for trading, so any kind of trading activities. But I can also designate in the same way as I could with assets. I can designate liabilities fair value. What I'm looking for there is an accounting mismatch. I need to, or it's managed on a fair value basis, or again to avoid bifurcation. So exactly the same as the assets. It's the exact opposite here in liabilities. Reclassification rules can be quite complicated because now I've set what my original classifications were, and I really don't normally want people to reclassify. I don't want them to move from one category to another. So I have quite strict requirements in terms of when that can happen. Moving into fair value through profit and loss. So I chose another category and now I want to move into fair value. Usually not allowed. The only time it might happen is when I couldn't measure something at fair value previously because the information was not available. Now the information has become available, I'm allowed to move it in. So derivative instrument, I might say, I couldn't find a fair value for the derivative instrument, so I measured at amortized cost. Once I find the information, I measure it at fair value. Also difficult to move stuff out of fair value. So it's not allowed at all for liabilities. Once I've chosen fair value for liabilities, I'm stuck with it. From an asset perspective, very rare, and it's only when, it's only for non-derivatives that can be moved out, where fair value option was not used, and I've actually changed my intention. So I had an asset that I was once managing at fair value, I was actually trading in this asset, and I'm no longer trading in the asset. The exception to that is illiquid equities and derivatives on those illiquid equities, when I can prove to the satisfaction of my auditors and to my satisfaction of myself that I can no longer measure them reliably. In that circumstance, I can take them out of fair value. If I can't actually get a reliable value for it, it makes sense to move it to amortized cost. Okay. Then nothing happens until the day you sell it, and on the day you sell it, you recognize fair value. Okay. All right, held to maturity, change of intention. So I can move it into held to maturity where there's a change in intention. It's reclassified, it can be reclassified from fair value, profit and loss in rare circumstances. And sometimes I might have been under a tainting requirement to your question, and now the tainting requirement has expired. So I've behaved myself for a period of time, tainting is expired, I can now move stuff into held to maturity because I've now sort of proven, I've ticked the box that I've behaved. Likewise, moving out, I can only move out of held to maturity if there is a change in intention, but in that circumstance I will now taint the category because I've changed my mind on something that's a tainting event. Loans and receivables, you can move stuff into loans and receivables where there is both the intention and ability. So you've actually had a change in that intention and ability, and as a result you can move it in, and they can come from either fair value through profit and loss or available for sale, but you are not allowed to move them out, your point. So loans and receivable, even when I have the intent to sell, it stays in there until I sell it. And when I sell it, I recognize it. Now, there's a reason for this. And the reason for this, and not because I now want to call all bankers bad, because I was a banker and I know at least some bankers were good. But the problem with this here is one of the tricks that you have is that if I have a loan book on my hands, what very often happens with a loan book is over a period of time, the poor quality loans drop out, and I'm left with an improving, better and better quality loan. As the loan approaches the end of its life, its quality is improving because there's less and less left to repay. So the temptation to change this at a point in its cycle from amortized cost to fair value and suddenly have a nice profitable loan popping out on a fair value basis is quite high. So we just made it very strict. You're not allowed to move stuff out of loans and receivables into fair value. We're taking away the temptation. We're not even allowing you the temptation in those circumstances. Okay, available for sale. Can move into it. Any instruments that no longer qualify for held to maturity can move into available for sale. Reclassifications from fair value, very rare circumstances, usually when there is significant illiquidity in the market. And because of that, the fair value is no longer a fair representation of value. The market value is no longer a fair representation of fair value. You can move it out of fair value for reclassifications into held to maturity, as we spoke about earlier. For assets where you have the intention and the ability to hold them for the foreseeable future, and they meet the loans and receivables. So there are certain circumstances where you can move back out again here. So this available for sale can be a little bit of a holding pattern, but again, the requirements are very strict in terms of how you do it and when you do it. Okay, that's classification. Now I'm going to talk a little bit about recognition. Yes?
because I accumulated some questions for the end. First question regarding classification of equity instruments. Just because we don't have the definition, sometimes we face some problems. For example, we have an insurance company, and government has given some money for that insurance company. This money is only for the purpose of paying out to policyholders when the profit is not enough. In other circumstances, this money cannot be used. Can this be considered to be equity? Because what brought me into concern is obligation to pay cash or another financial asset. We don't have to pay it back to government, but we will have to pay it to our policyholders. Can it be an equity instrument?
It feels to me very much like the liability instrument, and that's because under certain circumstances, and they're very select circumstances, but under certain circumstances, the company is obliged to pay. So, and that's all that needs to exist. It's out of my control. At certain circumstances, the policyholders or the government can force me to pay it. Therefore, it's not equity.
Thank you. But and an analog is the equalization reserve that after this IFRS 4, many countries decided to take it out of liabilities, but they put it into an equity as an equity instrument. Is this consistent with IFRS?
Now, what we'll do is we'll talk a little bit tomorrow. We'll talk a little bit about on Friday about insurance.
Okay, thank you.
Insurance breaks half the rules of accounting, so we'll talk about that on Friday.
One more question. The guarantees that you give the option to use IFRS 4 or IAS 39. So we agreed that there is space for arbitrage.
Absolutely. We've tried to restrict the arbitrage by saying you make the decision once only. You can only be an insurer, so you can only do it if you previously did it. So you're allowed to continue doing it, you're not allowed to adopt it. So it limits the arbitrage, but there's certainly arbitrage. The fact that you have to do it up front, though, limits the amount of arbitrage, because obviously all that happens, all that differs between the two accounting, IAS 39 and IFRS 4, is the timing of the profits that you would recognize. And up front you don't know when that time is going to be. So it does limit the arbitrage.
Thank you. And below market loans, do we recognize the loss at once, or we split it to amortization of this with effective interest rate?
Sorry, what loan?
I mean, when we give below market loans.
So below market loan, what you're effectively doing is that you are giving. So let's assume, we used the example earlier. I give, if market rate is 10%, I give you a loan of 4%. The first thing is to try and identify if something else is happening. Why did I give you the 4%? If I gave you the 4% because you're my employee, then the difference between the 4 and the 6% is actually salary. It's the amount that I'm paying you. If you're a supplier, then I gave it to you because I'm actually paying in advance for some of the things that you're going to supply me. If I just gave it for no good reason, I've got an expense on day one. So I take the loan down and then recognize it over at the effective interest rate. So I drop the value of it, make a loss on the first day, and then have a pull to par effect over the life as I eventually get the payment back.
Thank you so much.
Okay. All right, so initial recognition. This is the idea of when does something come onto my balance sheet, when do I recognize it. So the principle here is as soon as I become party to the contract, as soon as I become involved in the contract, I must then recognize it on my balance sheet. An executory contract, though, an executory contract is a contract where two parties have to perform. Doesn't go onto anyone's balance sheet until at least one party has performed. So if I write a contract and the contract is, let's say, for the delivery of services, so I contract with you to deliver audit services for me, I don't show anything on my balance sheet until you have started to deliver those services. There's no obligation from my side, there's no asset on your side until we start to actually deliver those services. From an initial recognition perspective, IAS 39 allows you the choice of choosing settlement date or trade date, whichever is the preference. It is an accounting policy choice. So once you've made the choice, you stick with the choice. It's only available for regular way purchase and sales, not for net settlement purchase and sales. One important point though is that for short sales, industry practice that is developed now is gross liability. So you recognize immediately with the gross liability on the balance sheet. But there is a choice here in IFRS 39, in IAS 39. Once made though, you stick with that choice going forward.
When the question is about spot operation, for example, exchange of currency, and one currency is paid and another one will be paid in one day just because of the difference of time in different countries. Has it be recognized as a liability or a receivable?
Absolutely. So the moment one party has performed.
Or it depends on what kind of policy we choose, the settlement date or...
So if I look here, the trade date is always earlier than the settlement date. Okay, so if I were to look at this, I would say if my policy was trade date, then the moment that transaction was traded, it would be on my balance sheet. Okay. So then this issue wouldn't even happen, because when the cash was received, I de-recognize the asset and have cash, but I continue to recognize the liability which I've been recognizing all along. Okay. If my policy choice here was settlement date, so now I'm looking at the later of the two dates, then the moment the first leg of settlement has happened, I must raise the corresponding item. I must raise the liability on that side. So in essence, what trade date and settlement date are all about is that if I choose trade date, then on the day I trade, on the day I conclude that I will raise an asset, being the thing that I'm going to receive at a future date, and I'll raise a liability, being the amount that I will pay for it at a future date. So let's assume I've got a T+7 delivery settlement. I'm going to immediately raise the liability that I will pay in 7 days, and I'm going to raise the asset as though I already have the asset. If I choose settlement approach, what I'll do is on day 0, I will recognize probably naught as a net amount. But over the days as I move to day 7, I will recognize changes in the value of the asset versus the liability. So I'll treat it almost like a derivative. And then as soon as, so let's assume in this example, settlement occurs on the 7th day, but actual payment occurred on the 6th day. Well, then I've paid, so my liability is off the balance sheet. If my liability is off the balance sheet, I must have an asset somewhere to balance this, so I will recognize the asset. So as soon as the first leg of settlement happens, if it's a multi-days, I have to bring the whole thing on, because settlement has started. Does that make sense? Alright, so just measurement, the way we actually initially recognize something on day 1. If the instrument is at fair value, and just to give you an idea of what the picture is that you're looking at here, red blocks, the actual value that the transaction was done at. The grey block with the little yellow line outside it is the transaction costs that were involved. So the second column shows that I've actually done a transaction at fair value with certain costs. If I'm accounting for that transaction at fair value through profit and loss, I will immediately recognize the fair value on my balance sheet, and I will immediately recognize the transaction costs in profit and loss. Transaction cost goes straight to profit and loss, and that's the end of it. The reason I do that is because a minute afterwards, if I were to revalue that instrument, I would revalue it at the red block, and the grey would suddenly show up as a loss on, which doesn't make sense. So I need to do it that way. Moving to the third column, if I were to buy an asset at a value other than, and record it on my balance sheet at a value other than fair value, so this is an amortized cost asset, I take my initial value that I paid for the asset plus my transaction costs, and I record both of them on the balance sheet. Reason being, I'm not going to record the fair value over time. The transaction cost was part of my acquiring that asset, so I reflect it there. Liability is exactly the same principle, except now because the liability is on the other side of the balance sheet, it comes off instead of going on. So I actually get what I would get is if I had transaction costs on a liability, on day 1 I would get a lower liability, a smaller liability, but because my liability pulls to par, I'm going to have a higher effective interest rate, because I reflect the net amount of the liability that I received. You want to use the mic?
Use the mic.
We have not yet changed currencies. I given you money, didn't get the money. But we have already agreement whether I must do something recognize receivable and payable.
So if your accounting is trade date, the answer is yes. If your accounting policy is settlement date, you must only recognize the net movements. So if the fair value of the asset moves, you need to record the fact that the fair value of the asset is moving. So it means that between settlement date and between trade date and settlement date, you recognize the net. If your accounting is settlement date, you recognize the gross. If your accounting is trade date, you recognize the gross immediately.
My balance sheet will go up.
Absolutely.
Asset and liability.
And that's exactly why a lot of banks choose to go with settlement date rather than trade date. They don't want to
because it's something artificially increasing the balance sheet that maybe the operation will not take place in general.
Exactly. So they just reflect the net amount in that circumstance.
Thank you.
Okay. Somebody asked me earlier about the question of what happens if the transaction is not at fair value, so transaction price not equal to fair value. That might be it's not at arm's length, it might be duress or force, unit of accounting, etc. First question you have to look at is whether you've paid for something else. So the example I gave you was if I've actually paid your salary is part of a lower interest rate, then I must recognize it as salary, I must recognize it for what it is. So that is one of the things that you need to take into account here. Otherwise, you must take the present value of the cash flows you expect and show an immediate loss, a loss on day one. So subsequent measurement, if it's fair value through profit and loss, subsequent measurement is at fair value and all the changes go through the income statement, nothing through other comprehensive income. If your choice was either loans and receivables or held to maturity or liabilities at amortized cost, then the balance sheet is at amortized cost and the income statement simply shows your interest, your impairment, and any gain or loss when you sell the asset, to the question you asked, and again, nothing through other comprehensive income. If you've chosen available for sale, this is the really tricky one, because what you've chosen with available for sale is fair value on the balance sheet, but amortized cost on the income statement. So you show the income statement exactly as though you had chosen amortized cost, and OCI is just where you balance it. Because now the problem is your balance sheet's still got a balance, you're recognizing fair value in one place, amortized cost in the other place. Whatever is required in OCI to get that valuation right goes through OCI. Okay, a topic that was covered a little bit in the questions and answers earlier in the earlier presentation was impairment. IAS 39 impairment is an incurred loss approach for financial assets. The impairment loss only recognized when a trigger event occurs. Something actually happens and the impact can be reliably measured. Losses recognized as a result of future events, no matter how likely, are not recognized. So really, really important here, this is not an expected loss model. Even if I think I'm going to lose money, if I don't have a trigger event, I can't actually account for those expected future losses. One of the concerns with our model, and we'll talk about it a little bit tomorrow in terms of how we're addressing this. You can have more than one impairment model depending on classification. So you might have one impairment model for loans and receivables, another impairment model for something else. Yes?
Does impairment, the idea of impairment, cover the fair value through profit or loss or something, the instrument which is estimated by fair value? Because the fair value always shows the current.
It's an issue. I mean, if you have a fair value instrument, you don't need an impairment because the fair value tells you what the amount is that you expect. So you have no impairment model for fair value instruments. What you do is that when you're looking at this from an accounting perspective, you might argue that a significant change in the fair value of an amortized cost asset. So let's assume that I'm holding, what was the Antigua government bonds. Okay.
Can the same thing be said about PPE, which is estimated by revelation cost?
Okay, PP&E is slightly different because with PP&E you have a different concept. If I'm looking at a financial asset, I only have one way to realize the money. I'm being paid it. Okay. If I have PP&E, I've got two ways. I can sell the asset and the fair value of the asset tells me how much I'll receive from selling it. Or I can use the asset, what's called value in use. So you think simply, if I buy a truck, on day one when I buy the truck it's worth 100. By day two I can only sell that truck for 50, because the value of a truck goes down very quickly on the open market. But I can actually use that truck for 10 years. So its value of use, there's been no impairment, even though its market value has impaired. So any kind of asset where I've got an alternate use for it, I've got one of two tests, value in use test or fair value test. Any asset here where I only hold it to collect the cash, I need to look and see whether the cash is going to flow. I get no other benefits from using it. One of the things that you have to take into account when you look at impairment is collateral. So home loans are a great example where you have significant collateral backing it up. But collateral can only tell you about the loss given default. It can't tell you about the probability of default. And because it's an incurred loss model says we expect the default. Collateral is not necessarily something that tells me about probability of default, so it's not necessarily an incurred event. The only time that a drop in collateral value, that a change in collateral value, might be a predictor, might be an incurred loss, is when that change in value changes my probability of default. So take a simple assumption, the non-recourse home loans that you find in the US, when the value of homes drop, people stop paying, because they don't have to pay. It's a non-recourse loan. They can just drop their keys off to their bank manager. In that circumstance, the value of my collateral tells me about my probability of default. So a drop in collateral value will tell me that I'm going to actually have higher bad debts. It is an incurred event. In the normal circumstance where I don't believe a drop in the collateral value will affect probability of default, I don't have an incurred event, and accounting as it stands under IAS 39 wouldn't really allow you to recognize a loss, wouldn't allow you to recognize an impairment. When you are using collateral, though, you have to bear in mind that it does affect your loss given default. So when you do the calculation of the amount you expect to recover, so I now expect a loan to go bad, or in fact the loan has defaulted. What I've got to do the moment I've got a loan in default, I calculate my present value of the cash I expect to collect and compare it to my carrying value, and the difference between those two numbers, the difference between my present value of expected cash flows and my carrying amount, is my loss. Part of what I'll do with collateral is I'll take into account the cash flows I expect to collect. I'll take into account how much I expect to sell that house for and discount that back to the day, and that is part of the recoverable amount, so it produces the amount of loss I will take. IFRS 7, Philippe will deal with it later, covers a lot of disclosure of this. Yes, do you want to pass the mic behind you? There's another question over here if we've got another one.
Excuse me, how do you define loss given default? What it is exactly?
Okay, so
actually,
we don't define probability of default. We don't define loss given default. The reason we don't define those terms is because they are used in various regulatory frameworks, and we don't want to override those definitions. So to be honest, we don't even use them in our terminology. I'm using them as a shorthand because I got used to using them. So really what I'm talking about, when I talk about loss given default, I'm talking about that calculation. The present value of the cash flows I expect and the carrying amount. The difference between those two is loss given default. The lady over there.
You wrote that collateral is measured at current value. What do you mean? What is it, the current value?
Current value simply means the amount that I expect to receive. What is the and usually, from my experience, what banks usually do is you look back at your history. So I know in South Africa, home loans, we expected to recover 65%. How do we know that? Well, we look back at the last 5 years, and 65% of the original loan value is what we recovered. So we then regarded that as the current value. That was our best indication of what the current value was.
So for collateral, current value might be equal fair value or not?
It depends on the type of collateral you're looking at. So if the collateral that I have is shares, so I've lent you money against collateral of shares, well, I know what the fair value of those shares are, so I can determine it exactly. So then, yes, it can be. And I would normally say that the fair value I expect to recover is the shares, the value of the shares. If it's something like a house, it's a lot more complicated, so I need to do a calculation. So, and the problem with the fair value, with the value, the current value, if I look at a house, it takes me a while to get the house on the market. I have to pay certain expenses to sell it. In some countries, there's a stigma of selling a house on auction, so it actually sells for a lower value. I have to take all of those into account in determining the current value. Is there a question over here? Oh, okay. All right. The other thing that banks regularly do is renegotiate loans. When they renegotiate, the bank has to look and decide whether in renegotiating the loan, they've just changed some of the terms. So they've extended the period, say. So I've got a home loan, it's repayable over 20 years, the person gets into trouble, I extend it to 30 years. That's really the same loan of the same house with the same interest rates, and I've simply made the period longer. Alternatively, I might substantially change the loan. I might say that you used, you borrowed money on a house. I realize you're never going to pay back the house, be able to pay back the loan. I can't sell the house, so I'm going to give you a new loan for 60% of the value of the old loan. I'm going to cancel the old loan and we'll start from scratch. From an accounting perspective, if you've renegotiated the loan, you must simply evaluate that new loan on exactly the same terms as you did previously to see whether you got an impairment. So just do the calculation of the present value of the cash flows you expect, compare that to your carrying value, and decide whether or not you need an impairment. You still have the original loan on your books, you don't de-recognize it, but you do an impairment test. If you de-recognize, if you substantially change the loan, then you must de-recognize the old loan, so you take the old loan off your books, you put a new loan on your books at the fair value of the loan. Now to calculate that fair value, you need to look at how much you would normally have advanced that loan at, what the normal terms and conditions of a loan like that would have been.
Don't we lose the history in this case? Don't we lose the history in this case?
You do, absolutely, you do lose the history, and it's up to the bank to decide whether they want to keep the history or not. But in this circumstance, and to be honest, in my experience, it's very seldom that this happens, that you so drastically restructure a loan. The best examples I've seen of restructuring loans is what they call loan consolidation, where I take your home loan and your car loan and your credit loan and put it all on your home loan. Then that home loan is now a new home loan. It's got new terms and conditions, it's got new, but it's very seldom. I see it very unusually. But yes, you do lose the history when it happens.
Sorry, but the loan is restructured.
If the loan, because we had this issue with the NPLs and so on, and if the loan is transferred from loans and receivables to fair value, it's a completely different game. But if we have a restructured loan on which, for example, somebody has a loan on 10 years, but we prolong him on 20 years, and we are sure that he will return all the principal, but just in longer period of time. He also should be under fair value.
No, it doesn't. It's just fair value at day one. So what I will do, I'll calculate the fair value by saying, what is the interest rate I would normally charge this client? It's for a 20-year loan.
Okay.
What are the cash flows I expect to receive? Let me discount them all back to today. Now, given the scenario you just gave, I've restructured it from 10 years to 20 years. I absolutely expect he can pay for it. If I've done that restructuring is now under normal terms and conditions, so it's the rate I would normally charge that client. Then when I do the fair value should equal the carrying value. There should be no loss.
Yeah.
But if I've restructured it and the interest rate is now lower than the rate I might have given it, under normal circumstances, then there will be a loss. And this is just to determine if that loss exists.
But at initial, you said at initial recognition it should be at fair value, and the next day I can transfer it.
Amortized cost, absolutely. Remember, every loan, go back to the recognition principle, generally speaking, every loan should be at the transaction price, but that's on the assumption that transaction price equals fair value. If they're different, then the loan must be at fair value. Right, why don't we like this? We don't like the incurred loss because it recognizes things too late. It doesn't show losses that people expect to have happen. So even when I know, so a very typical example under IAS 39, interest rates are going up in my country. I know that because interest rates go up, I'm expecting interest rates to go up. I know when interest rates go up, I make losses. Can I recognize those losses? No, because interest rates haven't yet gone up. So one of the big criticisms of the IAS 39 model is it recognizes things too late. It recognizes them after it's happened. And so it's one of the things that we will talk about tomorrow that we are trying to change with this. Just indicators of a loss event. How do I know when a loss event has happened? Significant financial difficulty, bankruptcy, default or breach, concession of the debtor, the market disappears. All of the normal things that you would be looking for in a banking environment are indicators that a loss event has happened. And the way we measure it, as I mentioned, it's the difference between the carrying amount, the amount on my balance sheet, and the present value of future cash flows. There's a mistake in your slides, just to note on this one. When I do the measurement of impairment, if it is a individually significant asset, the top gold block should be individually significant, I must measure it individually. If it's not individually significant, it's part of a pool of assets, I can either measure it individually or I can simply measure the whole pool. And so as I say, there's a little mistake there on the slides. Okay, derecognition. I derecognize assets either as a consolidated group or individually. I derecognize it. I can also derecognize a part of the asset instead of the whole asset. I do need to measure and see whether or not I have continuing involvement. So I would only derecognize an asset if I've transferred all the cash flows and I have no remaining risks and rewards and I have no continuing involvement. I'm not party to that transaction anymore. I'm not going to go through this table, but this table sort of takes you through a test of doing it to decide when an asset comes off the balance sheet or when an asset stays on the balance sheet. This is another page that's really important from a regulatory perspective, because if you're looking at Basel's rules for when something comes off the balance sheet or stays on the balance sheet can sometimes be different. So sometimes things that accountants would take off the balance sheet, Basel requires that you leave on. Sometimes things that accountants would leave on the balance sheet. And the most classic example of that is a repurchase agreement. So a resale with a repurchase agreement, accountants would leave on the balance sheet, but because the legal terms say that it's sold, from a regulatory perspective, might actually go off the balance sheet. So it's worth working through this and understanding the processes there. Liabilities, you look for whether or not the liability has been extinguished, and if it has been extinguished, it goes off, or if it is substantially changed, and there's a 10% present value test on that. You would derecognize it and recognize a new liability going forward from that date.
Do we use...
Sorry, can you...
You said that if financial assets are substantially changed, we should derecognize previous financial assets and recognize new financial assets. Should we use this state 10% test for financial assets or not?
10% test is only for financial liabilities.
So for financial assets, we should have...
For financial assets, we give other guidance on what you should consider.
In our politics, yeah?
Yes.
And one more question. When we derecognize assets, we should recognize profit and loss as a difference between carry amount of financial asset and received...
Exactly right. So the carrying value of the asset on the day that I derecognize it now goes. Yeah. And I say, what did I receive for that
derecognize
carrying
financial asset, but we should recognize cash received, asset received, new asset received, and new liabilities which we...
yeah. So the aggregate value of everything I receive. So what I receive might be shares, it might be another asset, it might be a new loan, it might be cash. The aggregate value of all of those are what I received in. What went out was my carrying value of the asset. The difference between those two is my profit or loss. Usually a loss, but can sometimes be a profit.
How should we measure this new asset? For example, if new asset is house or car, at fair value or not?
At fair value. So you'll recognize all new assets that you get in a barter transaction will be recognized at fair value. Okay, recognition and derecognition. I'm going to leave those two topics there. If you've got any questions, maybe we can pick them up over lunch. The final topic that we're going to cover is hedging. And I'm going to go through hedging fairly quickly because we've got a session this afternoon on hedging too. Simply what hedging is doing is managing risks by purposely buying instruments on one side that offset value changes in instruments on the other side. So it's a very simple economic concept. I have a risk, I purposely buy another instrument with the opposite risk and combine the two, and hopefully the two risks offset each other. A classic example might be, and this is an example we've got in here, so it's I think the only example we're covering, so I'll do it very quickly. A jeweler is committed to buy gold in the future. He knows that the price of gold, in fact, in this case, he's actually bought the gold. He purchases gold now for jewelry that he's going to sell in the future, but the value of the jewelry that he sells in the future changes because of movements in the gold price. So he's at risk now that he bought the gold for $1,500 now. When he comes to sell, it might be worth more or less. So he tries to protect himself by buying a derivative instrument. Because the gold that he bought is part of his inventory, he doesn't fair value that, so it stays at amortized cost. But the derivative instrument he bought is at fair value, so it moves up and down. So what's going to happen for this jeweler is he's going to reflect a profit and loss on the one instrument. The profit and loss that's on the other instrument he's not going to recognize, and so you have what we call an accounting mismatch. It's a mismatch between the two different ways that you measure instruments on either side of the balance sheet. So hedge accounting says that if you have that circumstance, if you have one asset at amortized cost and a hedging instrument at fair value, you're allowed to fair value in some way the amortized cost instrument in order to achieve offset. Because what I'm doing now is I'm actually changing the rules of accounts. I'm saying something that by rule you have to carry at amortized cost. You now carry at fair value. We're quite strict on the rules about it. So there must be formal designation and documentation, and the instrument must be expected to be highly effective. So I need to be able to prove that that it is actually a hedge. I can't hedge my gold price risk by buying a platinum future, because I don't expect that to be highly effective. But gold risk and gold future will probably be highly effective. It's an election. So you don't have to do hedge accounting. You can choose to do hedge accounting. You can only do it prospectively. You can't do it retrospectively. And you have to continuously perform effectiveness testing. And if at any stage you fail the effectiveness testing, you're kicked out of hedge accounting. The hedging instrument, the thing I use for hedging, must be a derivative. And the hedged item or group of items must have the risk in them that is reliably measurable. I must be able to measure the changes in the gold price, for example, in order to do it. So I've got a couple of different types of hedge accounting. Fair value hedge accounting is where I'm trying to, the risk I'm trying to cover is changes in the fair value of the instrument. So the jeweler who bought the gold, the risk he was trying to cover is changes in the fair value of his gold. So that could be a fair value instrument. In this circumstance, what happens is I fair value the derivative, I fair value the hedging instrument, the gold. Both of those fair values go through profit and loss, and hopefully they offset each other and they work that way. The next type of hedging I've got is cash flow hedging. In this circumstance, cash flow hedging, I'm trying to do something different. I'm now not worried about the fair value of something, I'm worried about future cash flows. In this circumstance, it might be an asset or liability. So if I, for example, have a loan with variable rates of interest, I might pay more, I might pay less, I might pay more. What I'm trying to hedge is I'm trying to hedge the variability. I don't want that variability. I don't want the risk of cash flows going up and down. So I'll hedge it back to a fixed interest rate, to fixed cash flows. Or it can be a probable forecast transaction. So if I think of my jeweler earlier, if the jeweler was going to buy the gold in a year's time, He doesn't have the gold yet. He hasn't got an asset or liability, but he's going to buy gold. The cash flow that he's going to pay, the cash that he's going to pay for the gold is uncertain. It might be more or less depending on the price in a year's time. So he hedges his cash flow by determining right now what he's going to pay, by actually buying gold future, for example.
Can just a general distinction between fair value hedge and cash flow hedge be that you are hedging something as a fair value when you are hedging a fixed instrument with a derivative, that's a fair value hedge. And when you are hedging some instrument which is going up and down, it's a cash flow hedge.
Those are certainly good examples, yes.
Would that
So
be?
if you think about it, if I have an instrument with fixed interest,
Yeah.
then changes in the interest rates will cause the fair value to go up and down. So I have fair value.
Yeah. Okay.
If I have an instrument with variable interest, then changes in the interest rates won't cause the instrument to go up. So I've got no fair value risk. But what I've got in that circumstance is cash flow risk. So those are two good examples of fair value and cash flow risks.
Is it almost 90%?
It's a lot of the circumstances, yes. But I can definitely name some that are the other way around.
Okay. Okay.
Yeah. Okay. The important thing when you're dealing with a cash flow hedge is in many circumstances you only have one instrument. You have your hedging instrument, but I haven't bought the gold yet. I haven't actually bought it. So the way that a cash flow hedge works is I take the effective movement in my fair value of my derivative instrument, and instead of taking it to profit and loss, I take it to OCI. I take it to that place until such time as the transaction happens. The reason is because with fair value I had two sides of the balance sheet and I simply fair value both sides. In the case of a cash flow hedge I only have one side of the balance sheet, so I can only fair value one. So what I do is I take that fair value to OCI. If the hedge is ineffective, if it doesn't quite get it right, the ineffective portion goes to profit and loss. Now, the final type of hedge accounting is a net investment in a foreign operation. This is when a bank in the Eurozone buys a bank in Britain. They are exposed to the risk on their investment in that British bank because the British bank's operations are in pounds, their investment was in euros. This is hedging that net investment risk. And it's dealt with very similar to the way the cash flow hedge works. Any last questions? Yes?
Thank you. When I read IFRS 39, which is most extensively described one from whole set of processes, I got the impression that this standard doesn't like options as hedging instrument. It's right, yes, I'm right.
It does allow options as hedging instruments, but it has some restrictions on using options, and that's because the problem with options is they're kind of one-sided bets. So if an option can actually end up being a very profitable thing. And so that was the concern with options, but you can use options, but there are restrictions.
Because using options as hedging instrument is common. It's not something. Although there could be some discrepancy by users of IFRS between the operation and between the portrayal of the financial position, because they sometimes aren't able to portray this operation, this hedging, as they do it.
Yep. And again, we'll talk quite a lot about this tomorrow. The problem with IAS 39 hedge accounting is it's rule-based. We've tried to write a whole bunch of rules, and that means exactly the point you're making. Some of the things that we didn't like when we wrote it are in there, so we don't allow you to do things. There's a lot of rules, and the way accountants apply those rules sometimes doesn't reflect the economics of the transactions. When we talk tomorrow about hedge accounting, you'll see that we're trying to do a lot to improve it. We want to reflect the way risk is managed, not the way accountants think about risk. I will say that there are very few people who've read IAS 39, and very few people who have read it have understood it. So, compliments on picking that up anyway. Any other questions?